Hello everyone. So the topic we're going to discuss today is bond and their valuation. So in this lesson we'll be learning some of the key features of the bond and how to do the valuation of the bond. So as you already know, there are two types of securities for the funding, equity securities and debt securities, and bond is one form of debt security. Bonds are basically long-term IOU between a borrower and a lender. So when a government, corporation, or any other entity needs to raise capital for business expansion or for infrastructure projects such as roads, schools, or airports, they borrow money from investors. So investors who purchase a bond are essentially loaning money to these issuers for a fixed period of time. In return, investors receive a promise that they will receive interest payments at certain intervals and also have their principal returned on a stated future date. So we can say a bond is a contract between the bond issuer and the bond holder. The bond issuer can be a business corporation or it can be a government. And the details of the bond are spelled out in a contract called the bond indenture, which is a legally binding document. And the indenture can be quite lengthy and extremely tedious to read, but it is important because it contains all the relevant facts about the bond issue. This include information about the type of the bond, the size of the issue, the terms, the financial backing for the issue, and provisions that protect the investors. So before going into how bond works, it is essential to understand some of the terms of the bond. The first one is the par value or the face value of the bond. This is the dollar value of the bond that is to be repaid at maturity. In other words, this is what the investors has loaned to the issuer and will get back. Generally, bonds are issued in denominations of US $1,000. And then the coupon rate. This is the amount of interest stated in percentage terms the bond is going to pay on a quarterly, semi-annual, or annual basis. And the term to maturity of a bond is the number of years the debt is outstanding or the number of years remaining prior to final principal payment. The maturity date of a bond refers to the date that the debt will cease to exist. Now let's walk you through an example for the better understanding of the bond. Let's assume you buy a bond at a price of $1,000. In the bond indenture, it says the coupon rate is 5%, which makes a coupon payment of $50. Now, if the maturity of the bond is 5 years, then you'll be receiving $50 every single year for the next 5 years. And you'll also get the $1,000 back, the money you have lent to the bond issuer. So the total interest payment after 5 years is $50 into 5, which is $250. So you have invested $1,000 and you receive a total of $1,250, and you have made a profit of $250 from it. So just because a bond has a face value of $1,000 doesn't mean that bonds are always traded at its face value. Sometimes our bonds are traded at premium price, higher than its face value, or sometimes it traded lower than its face value at a discount price. So what are the factors responsible behind this fluctuation of price? One factor is the risk, another factor is the interest rate. The economic factor can affect the bond market and cause swings in bond prices. So if the economy is rising along too fast, higher interest rates are often used by governments. This may be good news for those who plan to buy and hold new bonds offering those higher rates, but not for those holding bonds bound at lower interest rate. For example, if you buy a bond at a price of $1,000 offering 5% rate with a maturity of 5 years, and after 2 years, if the market rate goes up to 7%, you would not be able to sell your bond at a price of $1,000 because no rational investor would want to buy a bond that is offering a lower interest rate than the market rate. so you have to sell your bond at a discount price. And the opposite thing would happen if the market rate has dropped below the coupon rate of 5%. In that case, the demand of your bond will go up, because now you are offering higher interest rate than the market rate. In that case, you'd be able to charge premium price. And another factor that also affect the bond price is the risk that is inherent in the farm. So there are a number of rating agencies which rate the creditworthiness of the farm. So farms having higher rating would be able to charge premium price, whereas farms having lower rating would be forced to sell their bond at discount price. Now let's move on to the valuation of the bond. The value of any financial asset, if it is a stock, a bond, a lease, or even a physical asset, is simply the present value of the cash flows the asset is expected to produce. For bonds, the valuation procedure is relatively easy. The cash flows are coupon and the principal payments are contractual obligations of the farm and are known by market participants since they are stated in the bond contract. Now, to do the valuation of the bond, we need a discount rate. So the required rate of return or discount rate for a bond is the market interest rate, called the bond's yield to maturity. The rate is determined from the market prices of bonds that have features similar to those of the bond being valued. By similar, we mean bonds that have the same term to maturity and same bond rating. So here in this example, it says what is the value of a 10-year 10% annual coupon bond if the market interest rate is 10%. So here the coupon rate is 10%. So if we assume the face value of the bond is $1,000, the coupon payment should be $100, and the term of maturity is 10 years, and the market interest rate is 10%. So this is the rate we are going to use as discount rate. So for the 10-year period of time, we'll be receiving $100 interest payment, and at the end of 10th year we will receive the $1,000 back. So if these are the future cash flows for the bond. So if we discount all these future cash flows back, discount them back into the present value, we get $1,000. It means all these future cash flows are worth $1,000 today. Most of the bonds offer a semi-annual interest payment. When I say semi-annual, it means the interest payment must be paid twice a year. Now, how are we supposed to find the present value of a semi-annual bond? Here in this example, it says what is the value of a bond with a semi-annual coupon with 5 years to maturity, with offering 9% coupon rate, and the market interest rate is 10%. Since the coupon rate is 9%, so the coupon payment must be $90. But this $90 will not be paid at once in a year. This $90 would be split into two different payments, and that too would be paid in different point of time in a year. So the first $45 will be paid in the month of June, and the next $45 will be paid in the month of December. And number of total payments will be increased too. So if the maturity of the bond is 5 years, instead of receiving 5 interest payments, you'll be receiving 10 interest payments, since it's a semi-annual bond. So that's how the valuation of the bond works.